An income statement is a key financial document for your business. It shows what your company earns, what it spends, and if it's making a profit over a specific period of time. In this period, we will talk about the main income statement items that a firm will register throughout its business cycle. Income statements may be prepared for different time frames. Year-end income statements cover the company's latest fiscal year. Companies may also prepare interim income statements on a monthly, quarterly, or semi-annual basis. What are the main parts of an income statement? 1. We have to start with revenue, also known as net sales. This item represents an inflow of economic resources. Usually the main type of revenue for a given firm are a day-to-day sales. Customers buying goods that the firm sells. There can be other sources of revenue as well. Companies can and do make money outside their core operations. For example, they can earn money by renting some of their real estate or by selling goods that they do not typically sell. The account that unites these sources of additional revenue is called other revenue. So this is the top line of the income statement. This is how the firm makes money. The sum of net sales and other revenue equals total revenue. 2. Below total revenue will be listed the firm's expenses or operating expenses. In order to fuel its sales and produce the goods that it needs to deliver to clients, the firm needs to sustain certain costs. The most common types of expenses are cost of goods sold, selling general and administrative expenses, depreciation and amortization, interest expenses. Cost of goods sold are expenses that are necessary to produce the goods that the firm sells. All the expenses that are directly attributable to the production of goods that are later sold are registered as cost of goods sold. The difference between the total revenue and cost of goods sold is called gross profit. This is the profit a company makes after deducting the costs associated with making and selling its products. Selling general and administrative expenses are a large category of costs. They are classified as advertising and promotions. Salaries of management and personnel that are not directly involved with production, accounting, office and auxiliary personnel, rent for its offices, and utility bills such as electricity, phone, and water bills. Depreciation and amortization (D&A) are two accounts that reflect the using up of tangible and intangible assets. Depreciation refers to assets of a physical nature, while amortization is the term that is used for intangible assets, goodwill, licenses, copyright, etc. Interest expenses are the costs that a company bears for receiving financing. Typically, firms receive bank loans and pay interest expenses for the amount they owe. Every year, the firm has to pay an interest expense on the amount that it still owes. Such interest expense is registered in the company's income statement. Taxes. There are two things that no person can avoid, and one of them is paying taxes. Every firm pays corporate taxes that are proportional to the amount pre-tax profit that is generated. The rules according to which the amount of pre-tax income generated by the firm is measured may vary depending on the country where the company operates. Formula of net income. Once all expenses are considered, we arrive at the bottom line, which is called net income. This is the excess of revenues over expenses, the profitability of a venture after accounting for all costs. These are the typical items that you will find in an income statement.